Hi everyone, welcome back to another episode of Fraser's Capital podcast. Today I'm delighted to have Eliana back on. Eliana, how are you doing?
How have you been, Mike?
I'm good. There's been a huge rip in a lot of US growth stocks, a lot of which we own and just bought back. I remember a few weeks ago asking you what you thought of everything we owned, what was the best, what was your favorite? And you answered HIMS. And funnily enough, that's probably been the best performer in the last couple of weeks. So what do you think of that now?
HIMS has been one of my long-term favorites, and after their Q1 report, I think it continue to be. So, for those who don't know, HIMS is an American telehealth company. They focus on men's sexual health, women's health, mental health, and weight loss. They $13 billion market cap, and they just surpassed 2.4 million subscribers.
It's a bit of a battleground stock. It's got like 34% short interest, and it's kind of captured the imagination of a lot of retail and now institutional investors. Like we noticed there's like an entire podcast dedicated to hymns where they get a bunch of different guests on, including the famous farmer bro Martin Shkreli. Highly recommend listening to that episode, actually. I'm always confusing these companies with this really high short interest because it's growing at over 100% in its latest results. It's accelerating. It's done deals with Novo. There was loosely a bear case that as GLP-1s came off the shortage list, they wouldn't be able to compound it cheaply anymore. But now they've come out with a deal with Novo, which kind of answers that question here. I mean, it's still a relatively small company given the market size.
So after the weight loss shortage in the US was announced to come to an end, I think it was February 21st, they announced a deal with Novo so that they could keep offering Wegovy at a discounted price and keep up their subscribers. Right before that, the Super Bowl, they also released this huge ad, and it was really controversial at first, but they ended up getting a lot of stock interest back from that and regaining share price.
What did they say on the ad?
The commercial was called Sick of the System, and it was all about weight loss in the US. And I think it's over 70% of adult Americans are considered overweight. So it was really kind of confronting for what it was, and it was nationally publicized. And as you can see on 10th of February, they actually just had a huge rip after that. So it was really well received.
It's really interesting. Liraglutide's basically off patent now. Semaglutide, apparently the patent could be challenged because it's been around for so long. 5 years, people be off patent, people be able to make it, sell it really cheaply.
The reaction was said it was really controversial and misleading around weight loss, but Hims and his value proposition, they lay really firm in the sense that they're not just giving people prescriptions online, that they're also holistic support. So they'll give you an entire plan. And that's what they're doing right now. They're switching the value proposition from just giving people medications online and bypassing traditional GP to an overall support of people who use a bundle of medications provided and tailored to them every single day. So they're moving into subscription based long term retention of customers.
Yeah, I mean, it's wild when you look at that share price. We got a 2x and like basically sold it all before the collapse. Not at the top, sadly, sometime before. We didn't quite top ticket, but it went from $70 all the way down to like low mid 20s in just a couple of months. This is one of those classic stocks. Well, it often happens when there's like a battleground stock where there's a huge amount of short interest and like a really devoted subscriber base. It reminds me of Tesla in the early days when they're growing super fast. But you can see in the quarterlies, it's like a metronome. Every quarter, they're adding a bunch of new subscribers and revenue's growing super fast, like 111%. When we talk about explosive growth, that's really what we're looking for. It's basically just doubled after we got a last buy signal, around 28, 29. More than doubled actually. You've got this huge volatility in the stock, and the fundamentals are just growing super fast. And there's so much opportunity for this company to expand. And it's also that there's a ton of people trying to do it, but for whatever reason, HIMS has kind of got the formula right. They're taking market share into a super fast growing sector. And now they're actually getting pretty serious operating leverage as well and increasing profits. So I reckon this is going to be one that we're going to own. Obviously, managing our risk. I think if you just own this long term, you probably do extremely well. But you just dropped 65% in 2 months before doubling again. I reckon that's probably the kind of volatility that you're going to see. Our approach is basically own it when it's going up. Take those momentum swings, take profits at the right time. I reckon this is one where there's a good chance it doubles again by the end of the year. If they continue posting quarters like this, and that short interest stays that high, that's huge losses. That's billions of dollars of short losses just in the last 2 or 3 weeks. So That will be really interesting to follow. Heavily shorted stocks like Carvana, they really kind of top when that short interest finally folds and has to buy back. So yeah, it's a super interesting company. I think it's definitely one that people should be aware of and taking a look at.
And what do you think something like Hims and Hers means for general healthcare and telehealth in the US, considering things like liraglutides and semaglutides becoming less regulated and more easily accessible?
I think it's more like they'll, if you think about it, there's kind of a bit of a cartel around GPs and certainly pharmacies as well. You know more how it works in Australia than the United States, but it's really hard to get access to some of this stuff. A lot of people are overweight, don't get treatment. And the amount of people that go to their doctor, they generally only do it when they're really sick and kind of borderline incapacitated with something. It's because it's so hard. You have to go to a doctor, make an appointment. People work and have commitments outside of it. You really only do it when you absolutely have to, which is bad because it means a huge amount of things are untreated. A lot of diseases that we look at companies trying to treat, they'll be like, only 15 to 20% of the population is actually diagnosed and treated with this. The real population is much bigger. So they've got a real opportunity now with millions of subscribers growing super fast. That could get to 10 million subscribers. The subscribers could 4x much faster. And once they're in that system, it's easier for them to speak to somebody or get information on other conditions and then ultimately get treated. It might expand the market for a lot of different things. And yes, this is kind of like sexual health, hair loss, weight loss. It's not really those more serious illnesses where HIMS isn't really going in that area. But these other conditions, there's a huge market for it. 2.5 million subscribers is less than 1% of the US. So there's a huge amount of room for this one to grow. And it's rare to find this. Often when you see these companies, they're already at like 20, 30, 40% saturation. Maybe they can double their users, getting more revenue per user and more profit per user. This is still at the beginning, less than 1% penetration. So pretty excited. I think this is one where we lift our profit targets to the upper range of 4x from our entry price. But yeah, I would say buyer beware. It's going to be volatile. There's going to be short selling, short covering, huge amount of volume. Like I said, there's an entire podcast devoted to this company. It's really going to become one of those cult stocks. And we know better than anybody that those things can go up 10, 20, 30 times. Actually, we've had a few that have gone up 30 times. But also the downside in these is definitely 65 to 80% from the top of those swings. It's the perfect one for us because we're trying to catch these big momentum swings and realize profits. And then that later part of the rally, that's probably where you want to step aside, get the popcorn out and just enjoy the show rather than sticking it out. If they can get from 0 to 1 mil, they can get from 1 mil to two. If they can get to 2.4, they can probably get to five, possibly more than that. It's a really interesting one.
Nubank also reported in the last 2 weeks.
That was interesting. I mean, it's almost like a metronome. It's like 5 million new customers a quarter, which has added up now to 119. So a huge business now in South America. Obviously, predominantly in Brazil, but pretty big in Mexico now and growing in Colombia. What they've done, the reason the market is, it's kind of peaked at 16 and has been hovering around, 9 to 12, probably in the upper end of that now. We're back in the stock with about a 5% position. Um, the thing that's keeping it a bit muted now is their gross margin and profits have decreased. They're branching into secured loans, savings and checking accounts and cash balance management, and generating most of their money from unsecured personal loans, which is a very profitable, very high margin, but very risky part of the lending space. And even in Australia, there's a bunch of different listed examples of companies that have set up lending businesses. And it's actually pretty easy to grow as a lender. You set up your website, invest in your systems, and then you give people money. It's a pretty easy pitch. Once the systems are in place, the way these credit businesses work, the first cohorts tend to be really good. Your credit quality is really high. The management is probably paying extremely close attention in the very early days. But as they grow, the later cohorts tend to be less high quality, more likely to default. If you give out a bunch of bad loans, they go bad 2, 3, 4, 5 years down the track. And then it's kind of too late to course correct because you've already been lending on poor standards. And there's a long history of companies listing, growing super fast, putting out money. It's really easy to grow. The concern is there's often these things kind of hit this moment where they suddenly realize that the last 2 or 3 years they've been writing bad loans and now they're just stuck with a bad book. And then you see big collapses and write downs. And that was the reason not to own this kind of growth profile. You should assume if you see a credit business growing super fast, that the first cohort's high quality, it's easy to put out money. But as the business grows, the loan quality is going to deteriorate. And there might be that moment where bang, like the music stops. you suddenly realize the last few cohorts are terrible quality. Then you can get huge stock price collapses. Nubank is doing now is moving into more secured lending, so it's much lower margin but much higher quality. And I feel like at this moment they probably have the scale and the data now to actually do a good job. The quality of the book is going up. But if you look at the bottom, compare like the user chart at the top, which is like the number of users, number of customers growing very fast. Then look at the bottom, the net income. You can see that it's basically been flat for 3 quarters. It hasn't scaled with users. And that's that moving into lower margin aspect of what's going on. So long term, the profits will be generated by user growth and high quality loans. In the short term, moving from really risky high margin products to lower margin products, slow down profit growth. Ultimately, the value comes from the users and they're making the right strategy. Um, there's this dynamic going on, so it's kind of muddying the story. And then you have to have that caveat with all lending books. You only really know the quality of the loans written today in 2, 3, 4 years' time. So that's kind of the risk. But I'm ultimately think that customer growth will drive value here. And the fact that they can go into all these different countries in South America, they're hitting their strides in Colombia, and there's a number of other countries they can enter. Because this stock has gone down to sideways for so long, there's a good chance when the move comes, you could see this 2 or 3 times the value. It's just kind of transitioning now from high margin products to low margin. As you can see here, Colombia, 3 million use. The more you go into financial services, like insurance, banks, and less about the earnings statement, more about the balance sheet. One thing that is exceptional about new, there's very few companies of this scale, 100 million plus users growing at 5% a quarter, and their broader services even faster. So I think like long term, this will be one of the big winners. If they have been in the high margin area, they earn huge returns on equity on those loans. These are high margin loans. You're talking about a return of equity of like 27, 28. If you think about it, like if it's a company selling widgets or iPhones, generally you look at revenues, margins, profits, and then price earnings or EV/EBITDA or EV/EBIT. You often use ROE and price to book. So if something's got a 10% ROE and trades at 1 times price to book, it's kind of like a 10 times PE. This has a very high price to book, but that's because the ROE is like 27, 28. And that's broadly how you get to that 17, 20x PE. Um, it's probably cheap relative to the opportunity, with the caveat that there is this credit risk. So again, like with our strategy, we bought it down to 5, sold at 12 to 15, bought back around 12 to 13. I think with credit businesses, you really want to have risk management because when it turns, the turn in the financials will come long after the turn in the stock. People will slowly realize from the insiders the credit quality is deteriorating. And the last person to realize that will be somebody looking at late financials. Quality deteriorating, defaults and arrears rising to a bad earnings result. So that will come out in the share price long before it comes out in the financials. So that's why I think risk management is super important for this one as well. There's still so much bad tech out there, so many bad consumer experiences. We had one when we had to transfer some money to India in another business, and it's a disaster. Like thing bounced, and they said we can give you the money, but it's going to cost you 10% of the amount. It's like thanks CVA, we're going to do any transfers with you ever again. But from the bank side, they're making so much money out of this stuff because just going into international effects, they rip everybody off so much. Like they rob you blind. Like I can go on one of my accounts and just transfer direct market access into FX with the tiniest spread in financial markets. On like the Aussie US dollar spread. Like there is no cost to this. Banks will charge you 5% on each side if you let them. And that's actually created this whole opening for, TransferWise. And because Australian companies are doing extremely well. They all build, they're like, okay, we'll let you transfer money overseas for a tiny amount, which is still a huge margin relative to this basically zero that it costs them to do it. Um, but the banks can't give up this profit pool. Like they have quarterly earnings. They can't just all of a sudden lose 2 or 3% of their income or whatever it is. They're kind of stuck there, which has created this huge gap. And then I think ultimately that's probably the wrong decision from them because once people go into these, wow, this is really, really effective. Revolut is another good example in the UK. Like I opened a Revolut account just so I could travel around and use FX without getting pinged 5% each time or more. But then you go, actually, this is a better platform than the top Australian banks. So you end up using it more and more. Yeah, I think they've probably made an error there, but who knows? CBA is doing exceptionally well in Australia. The bank's super profitable.
Transferring money, even on a personal level, can be difficult when you're traveling if someone's international. In Australia, we all transfer bank to bank directly. In the US, you have Venmo, Zelle, and PayPal, which people exclusively use there.
Exactly. I mean, that's one of the issues that Square has. Block obviously had a terrible result. It's one of those growth stocks that dropped 70, 80% and just never really recovered. They have Cash App, but Cash App, why would anyone pay money to transfer money? It should basically be free. The profit margin everybody's excited about is probably way lower. Like my view on all those payments companies trying to make money out of transfers is that, the trend to the cost to transfer money is zero. It's going to become extremely fast. It's just database entries changing, right? Sure, there's a bit of security and complex systems involved, but at heart, there's no reason for that not to be very close to free. So I think that entire profit margin of that industry with a ton of competitors that were very well funded, they can still fund themselves by, for example, paying employees in stock. Um, the ultimate margin, the long-term profit pool of that is actually much lower than people are expecting, and it's probably actually shrinking rather than growing over time, just because those margins are coming, and because the Revoluts, the TransferWises, and then potentially eventually even, it wouldn't surprise me if the banks are like, fine, we'll just make it free as well to do this stuff or extremely cheap, or create a new app that links in with your CBA or ANZ account that allows you to do this stuff really easily. It's the future. So it's pretty tough to invest in businesses, I think. Like your default for a fintech company that's in that space should be that the size of that market, size of that profit pool could shrink dramatically rather than grow. And margins will be extremely tight and going the wrong way. Um, but yeah, I guess that's New Bank. New Bank isn't based around international money transfers. This is a different beast, different company. What else reported?
Slightly disappointing quarter for them. Their marketplace underperformed, and the amount of items sold decreased from Q4 2024 and Q1 2025, as you can see from 7.8 to 7.4 of like items sold per unique buyer. And then the daily active users actually decreased a little bit as well. So I think they're just losing a little bit of momentum, especially when they have such direct competitors in marketplace spaces. There's so many platforms now, and there's so many international platforms that I think can take over that market share that they've had. The fintech section of the business actually performed well.
Strong growth. Again, good competitor, New Bank actually. Like Mercado Libre and New Bank are the two that we own in South America. We're not looking for undervalued micro caps in Brazil. Like, these are like continent-wide giants. The marketplace has been a bit weak, but the growth has come from fintech. I mean, this is the Amazon of that area. They've had competition from sea, there's competition from China in the marketplace, but it's come down from that hypergrowth phase, but it's good, solid growth stock in the area. Yeah, look, AMD is an interesting one. I think it's a good case study and always go for the number one. Like Nvidia just outperformed, has higher margin. AMD is cheaper, lower margin, costs roughly not too dissimilar amount to make, so gross margin's lower. They've got a new product suite coming out, which should be interesting. Obviously, everybody wants to foster an alternative to Nvidia where they can, which is kind of a tailwind. But I've noticed that this year revenue growth was pretty strong. In general, the revenue growth year on year has been low relative to Nvidia's. Nvidia's really captured both the growth and the profits of of the industry. But this is a stock that is, it'll be interesting to see how it reacts with this new product suite. It's an example of how the semiconductor sector has been really challenged because the whole sector got red hot, but really it was only Nvidia and Taiwan Semiconductor that captured the value. A lot of it's not companies are extremely focused on GPUs and AI, whereas the smartphone part of the market has just been slow, as has autos, which was another area that everyone was really excited about a couple of years ago. That the growth hasn't really come there that was expected. One to watch. I think to own this, you have to have really high conviction they're going to take market share from Nvidia. Um, this is a pretty good comparison from somebody on Twitter, invested visuals. You can see the Nvidia growth rate and higher free cash flow. You can also see that it really kind of AI boom. That was when Nvidia took off. So I guess in investing, you always have the option to go for a number two that's cheaper and not as good. It's a trap. After all these years, I still do it all the time. Like it's just a general thing that you instinctively do. Look for the cheaper company that's maybe less red hot, less well known, or less covered. But I
Mhm.
think at the moment you probably still want Nvidia. Semis is interesting because ChatGPT is still kind of throttling users. The demand is there. everything is set for like a huge semiconductor reversal. And there was a huge bear market in semis. They went down for a year, like 35. I think in like February to the low, that was like a over 30% drop. So it's not like the semiconductor's been red hot for a long time. But really, because everybody was so NVIDIA focused and everybody piled in, like all the ingredients are there. It's kind of like in February, everybody was max long. All the ingredients were there for a shift to max short and a big sell off. Everything is lined for NVIDIA to just collapse and just be one of those up and down stocks. But what's changed is the demand is just still there. It's ultimately going to be driven by that. And if they're throttling users, if ChatGPT, if people are still buying every GPU they can get their hands on, there may be a time that it does reverse, but I just don't think it's here now. If anything, I think it's the opposite. Semiconductors have sold off for so long, it's probably time for them to kind of recover a bit. If you look at those valuations, they're not expensive. Nvidia went back down to 20 times forward PE, possibly higher depending how you count, but possibly lower if you assume that growth was going to continue. And even now, it's bounced from 88 to 135. The big move, 30% move in a month. Even now, it's at 24 times forward PE. This isn't some psycho crazy stock. If that was twice that at 48, the stock doubled, which it could over the next year, the multiple could double or halve. That would just be normal market behavior. But then it would be red hot. But the value on the valuation basis isn't there at the moment, I don't think. Not while the demand is that high.
See that demand remaining consistent in the next couple of years.
Yes, because I think the agents will take off. Everybody's already using it a lot more. The younger you are, if you're going through school or university now with ChatGPT, that's a habit for life. People are saying now the same way that I'm like old enough. I remember when people used books, right? Like physical encyclopedias, not like Wikipedia, physical encyclopedias. And I remember when Wikipedia came out and it was a big thing. It's like, oh, everyone's cheating. They're just using Wikipedia. You're not allowed to use Wikipedia.
Hmm.
Everyone's like, oh, we're just going to use the sources then. But that was the same debate. And now that just sounds a bit silly. Of course, you go on Google and you start your work there to learn what you can. It's the same thing with ChatGPT. ChatGPT is so much more powerful as well. You can summarize everything. You can ask it questions and say, just go deeper on this, deeper on that. People that use it well are going to be vastly more educated and smarter, and not necessarily smarter, but vastly more educated across a much broader kind of yeah. If you're like an intelligent person that it just keeps probing and asking questions, you're going to be significant. You're going to know significantly more yourself than you would have before, because that would have previously taken you hours of reading books and searching through libraries and trying to find texts. And if you're in a college library, maybe somebody's already in your tutor group has already taken out the books. You have to walk to the other side of the university. That stuff isn't going to really be a thing anymore. I think it continues. The biggest irony of all is that coding is the area that AI has really taken off and been most useful. But it's very hard to work on large code bases. If you want to spin up an app prototype, you can basically do that. You can one-shot simple apps, and then give you instructions on how to hook up all the various APIs and link to all the systems that you need to do, which otherwise, unless you've done it many times, just setting everything up can take ages, and be really difficult. That stuff is now completely trivial for prototyping. But on big code bases, speak to any engineer, speak to any of our engineers that are working on Frat. They'll be the first to tell you that it can't do it. And it'll make changes that end up ruining things later. And um, like even where it's most advanced, there's still a huge amount to be done. The only way it can handle a huge code base is to do a huge amount of compute and a huge context window. The only way it can actually improve and do the things that absent some catastrophe over the next couple of years, is for those context windows to expand, is for the AI matrices and they're doing their calculations to take into account huge amounts of data. And then for each calculation, each time they generate a new token, take into account or with bigger and bigger context windows. That's the only way they're going to do what everybody wants them to do. And that's going to need vastly more compute. That comes straight back to how many NVIDIA GPUs these service providers are going to have to provide. 2 years, it's crystal clear. The value is captured by NVIDIA GPUs. And there's a good chance that continues. And everybody else at like the large language model layer, everybody fights it out. Now that's crystallized into ChatGPT being a clear winner, like DeepSeek or Claude or even Google will win for a couple of weeks and have more downloads. But the vast bulk of people, it's ChatGPT. And I actually think that they're going to end up, I mean, already the folder system in ChatGPT is better. It's got all your history. As it starts to learn more about what you want and your level and what kind of answers you like, it's got all that data. So I think it will be the best product. Um, The flip side is Google's been smashed, but Google is also getting a huge amount of data. So you'll notice when you search Google now, it gives you that little AI summary. And if you click that, you then read the AI summary, and usually it's pretty damn good now.
Mhm.
I think they say a billion people are using Google AI now. I think that's what they mean. If you interact with their AI by clicking that read more button, they're getting data over what's interesting, what's good, what people like, what people click on, what they're going to spend time scrolling through and actually reading. So Google, by slipping that AI snippet under their search bar, is probably getting as much data, if not more, than anyone. Google is still a sleeper. I don't think the bear case is there the way people think it is. And then remember that like the sheer volume of video uploaded to YouTube, which is public domain, let alone all the emails and all the kind of borderline private stuff that is another set of data, they're just going to win. They're definitely going to be there in AI. I think the bear case around Google and AI is tough, particularly now that it's so cheap with so much baked in. You take the other side of that. And, this comes back to that idea that you just buy the index. Like the NASDAQ 100 has all these companies. If you want to play this theme, it's got NVIDIA, it's got Google, it's got Microsoft, it's got all the cloud platforms. If one of them makes a strategic error and doesn't quite make it through, happen at their expense and to the gain and benefit of the others. Yeah, which is why in our fund we have to be so much more targeted, only going for the fast growing companies. I think in funds management, it's the space for having a fund that's, Microsoft, MasterCard, Google. I just don't think it's competitive with the index. Even if you're really smart and you get the next 2, 3 years right, 2, 3 years later, the game will change again. And within the index, all those winners will, whoever wins, or whenever there's a shift, whoever wins just kind of bubbles up because it's market cap weighted. The S&P 500 or other global equities, Google, like big tech just ripped through every industry. Google and Facebook became a cost line in every business on the planet. Every business had to use them to advertise. Similarly, Microsoft did the same thing. But if you're an office worker, you have to have Microsoft. They just taxed every business on the planet, and that expense came at literally straight out of the P&L of every single other company. And so every other company underperformed, and they just wiped out advertising, news, like media. They directly wiped out those, but more subtly added a cost line to everybody else, which you don't really see, but ultimately meant that underperformed. You've foreseen all those shifts, possibly, but it'd be a lot easier just to bet that those shifts are going to happen over the rest of our lives. But there is the flip side of that. There's always opportunity for the fast growing companies. And the fact that more money is going in that direction definitely opens up opportunity. I wonder if that's why the market cycles now are insane. I remember a couple of years ago, people started saying everything's moving a lot faster. Look at the last 3 months. I mean, we went from like bull market in February to like, 35% falls in like semiconductors, biotech, 25% fall in the NASDAQ, which didn't happen for 8 years. From the bottom of the GFC, you didn't get a 25% fall in the NASDAQ till I think the COVID, I think it dropped 20% in 2018, but there's an 8 year period of no, we just had one that got mostly reversed just in the last few months. It was like, it went full cycle from bear to like sorry, full bull to full bear, and now we're kind of 75% back up to full bull. That's fast, really fast. And I wonder what it is. It's probably some mix of, yeah, I'm not sure. It could also be that the last tech bear market was pretty long, and so I think that's what tripped up a lot of people, ourselves included. Previously, all the bear markets were short. From the GFC and to the dot com were two rare, two 2 year plus bear markets basically, and then all the other sell-offs basically from you have to go back a long way to get a long bear market, like 80s kind of thing. The 90s, all the bear markets were really short. 1987 even was very short. That was months, not years. And I think like those two bear markets, because I knew a lot of the investors, I looked up to them. I made it my business to try and meet as many of them as I could. They were pretty scarred by those. Like if you had your career from the late 90s, use 2 year bear markets, like 2000 to 2002, and then 2007 to 2009, and then a 2 year recovery. Those people were pretty jaded and cynical, and then missed the bull market that followed. I wonder if this tech bear market has done something similar. This time, this sell off, everyone was like, whoop, tech's off again. There's going to be another 2 year catastrophe. Everyone just sold really quick on the sell button. But it's just kind of bounced back and the world hasn't really changed. It's a short cycle. So if I had to bet, 2022 to 2023/4 was so long and painful. It was really start of 21 to the end of 22. or the beginning of 23. Then big tech recovered, and then later in 2023, everything else started recovering. If I had to bet, I'd say the next few sell-offs are going to be short until everybody gets used to short, sharp, just in time for another 2-year catastrophe. But we won't get caught by that one. We're going to be very close on these risk models that actually perform best in those kinds of extended bear markets.
Moving on to biotech.
I'm actually somewhat on the side of the Americans here because the rest of the world is pretty smug about how cheap healthcare is for them. But the only reason that drug prices are cheap overseas and not in the United States, including in Australia, is that they're so expensive in the United States. In the US, the FDA approves things on safety and efficacy and doesn't worry about markets. If you go to the UK or other systems, the regulator and the government are basically the same thing, and they'll also do the pricing. So they'll say, we will approve this, it works, it's safe, and it's cost effective. You can now get it extremely cheaply on our national healthcare system. That's how everybody else works. The drug companies really don't care about the rest of the world. They do everything based on the US, on how much they can make in the United States. They charge a lot. They charge what they need to charge for the drugs. It's still not crazy profitable. There's a lot of money lost in biotech chasing those rare winners, right? You can't just look at the winners and see the profits there. You have to include the losses for everything that didn't make it through the pipeline, which is most things. The company price things based on the US market and then go to the UK or the EU and say, look, we've got this drug. These huge buyers will say, okay, look, we're going to pay this much. And it's usually very low and the drug companies will accept. It's the high prices in the United States that fund the whole thing. We do a lot of early stage biotech, certainly a lot of stuff that's phase 2, phase 3. Um, we're pricing this stuff all the time, running the numbers, like how much money could this thing make? What is the upside? And then it's all on the US market. So if you said, look, the US prices come down to the European market, it would be like, well, you can't do it. You can only do it because you're like, well, if this works, it might be $1 billion a year for whatever's left of the pattern. It's not like $1 billion years forever. It's like a set amount that you can model quite accurately. You go, this is the penetration, this is the cost that we can get in the United States. The whole world really is freeloading. If the US paid the prices that everybody else paid, it would be impossible to fund these several $100 million trials. I think this will have unintended consequences. The idea here is that like most favored nation status, whatever the lowest price is in the developed world, the United States gets. Now, I think the Trump's kind of selling this like prices will fall, but the pharmaceutical companies won't lower their prices. If they really have to, they will pull drugs from the EU and the UK. The US is like the
Mhm.
vast bulk of what they do. Why would you cut price on 75 to 90% of your profits just to be the same price as the EU and the UK? You won't do that. You'll tell the EU and the UK, look, we're gonna, and potentially Australia, look, you have to pay the US price now. And then they'll kick and scream. They'll say, look, we've done our own cost benefit analysis. We told you we can only pay 200 instead of 2,000 a month for this. That's all we can do. But the pharmaceutical companies, they're free companies, you know, and there's no obligation for them to sell products at a loss. The last thing you want is if the lowest price is a US price, that means European bureaucrat who can basically set price for the United States or in the UK, like some unelected official can set price. It's just not going to work like that. You know, if anything, this really strengthens the pharmaceutical companies' hands to go to those countries and say, you need to pay up. I certainly hope that happens because otherwise there'll be a chill. One of the things that I've always had as a really strong belief that is way different to what most people think is that drug prices should probably be higher. Extending and saving life is extremely valuable, but developing drugs is extremely difficult. People spend their whole careers developing drugs that mostly fail in phase 3 or before approval. Most people spend their careers developing things that don't end up having an impact. They spend such a fortune. Like, what can you make out of this drug? That directly affects what we will invest in Australia on a tiny scale with the local biotechs. But it's the same, everybody's running the same numbers. And materially, like that end number is literally what determines whether drugs will be developed or not. We need some more drug candidates. That's like not really true. There's heaps of promising candidates. You know, pharmaceutical companies regularly take some of the most well-resourced companies on the planet regularly cut entire programs because they have funding priorities elsewhere. You know, you can't fund everything. That is the bottleneck. The bottleneck is actually funding these projects. And whether projects get funded depends on the size of the end market. Um, I hope what ends up happening is all developed markets start paying their fair share and funding drug development. Eliana, you're younger than I am, but I'm still pretty young. If there's like 20 years of good drug development, there's a good chance of what affliction we eventually get is cured. There's a good chance. Think of all the work we've done on prostate cancer and all that. Like, there's a lot of things in flux, a lot of trials that we'll know the data of in the next 1, 2, 3 years. By 2030, a lot of these things will work. The treatment protocols will be so much better. Um, Treatments with lower side effects will be earlier in the treatment profile. Might be able to avoid doing chemo for the horrible disease. It's really exciting, but the last thing we want is to kneecap the industry. It's already been suffering.
I was
Okay.
just going to say, speaking of prostate cancer, and now they have mandatory testing. Hopefully, there's better testing coming out in the next few years so we can catch things earlier on. I think that's what I'm interested to see on the diagnostic side.
And like in things of garden health, that's done pretty well lately. All the companies doing blood tests for cancer, specific cancers, that's still realistic. At the moment, it's only in very specific types. Pan cancer screening it has to be combined with good therapeutics. The issue with diagnostics is there's no point having a diagnostic that tells you if you have terminal brain cancer if there's no treatment, or a less extreme condition that there's nothing you can really do about. Like, there's no point having that test. No one's gonna, like, there's no value. You need to change the treatment. It needs to be a test that's combined with a treatment that's ideally not going to do more harm than good. Whereas in oncology, that's been the real thing where
Yeah.
there's a long, long multi-decade history of radical treatments that often did more harm than good. It's interesting. You write a note about a random company and get a bunch of emails back. Then you do something super interesting. I'd be interested to do it. It's super exciting. It's potentially curative. They've cured it in small mammals. The cells that keep regenerating your hair, turns out they're basically the same, have the same embryonic precursor to neurons. I guess it's something to do with proximity. It's probably just how things evolved. You can basically convert them back into those precursor cells, put them in the brain, and they start spitting out new neurons. It's not like you're just pumping out cells in the brain, which some of these cell therapies do. They actually pump out the right neuron, which then organizes and travels along gradients to the right place and restored function in these dogs. Now, if you have like dogs are notoriously bad because every protein enzyme in your body, like it's just evolved slightly different. There's a lot of evolutionary distance between us and dogs. If you think about a small molecule drug, it's like a key in the lock. If you have millions of years of evolutionary distance, those shapes are just slightly different. That's why things that work in mice and dogs don't necessarily work in us. Small molecules are difficult. Typically, there's a receptor that works for something in your body. It's probably been used in multiple other parts of your body. And so if you find something really active, there's a good chance it's hitting that same receptor doing something completely different somewhere else, which is why you might get a very specific but very strange side effect somewhere else, which you only see in bee population, which is another reason why drugs fail. Cell therapies don't have that issue, but they should work. Like if this works in dogs and rodents, it should work in people. If you can actually generate new neurons which organize and restore function, that's a huge opportunity. The specific way they're doing it is different. It's not just putting random stem cells in there. It's a very specific kind. It's the patient's own cell. The next step in cell therapies is to find one cell that you can take from one patient and use in a bunch of people, obviously largely for commercial reasons. But that step comes with its own set of issues. The sidestepping the issues involved in that, I think is really exciting. And I wonder if it's probably got broader use. CEO mentioned Parkinson's, could work in concussion, CTE, people that have dementia-like symptoms because they got hit too many times in the head or took too many collisions in rugby or American football. Yeah, it's exciting. Should we wrap up there?
Sounds good.
Thanks for coming on, Liliana. If anyone listening wants to find more about us, you can see us at www.fraziscapitalpartners.com. And thanks for listening in.